In this video, we're going to compare the butterfly we were using in the previous video that had $5 between the width of the long and the short strikes, and we're going to compare it to one on the left here that has $3 between the long and the short strikes. Now I've set up the thinkorswim platform with some additional features so that we can measure the probability of these trades having success at expiration. And the way that that's done on this platform is you would just take the expiration of the options, December 15th, and if you come up to this calendar on the top here, top right, you add 1 day to that, and if you do that, it will give you the probability of this trade finishing between the break-evens as long as you draw some price lines at the two break-evens. In these pictures, what I've done is I've removed the current price of the stock, and I just have lines drawn at the break-evens of the trade here and here for the $3 width one, and over here I have the lines drawn at the break-evens for the $5 width butterfly. And notice that the $3 wide one has a probability of 26.11% of finishing between the break-evens at expiration, and the wider one has a higher probability, 33.79%. But as you look at the trades, notice that the higher probability one cost more, $235 as the debit, and you're trying to make approximately $260, $265, where the one that's a little bit narrower, you are trying to make a little bit less, $200, but you're also risking less. You're risking $100 to try and make $200. So some people would look at this and say, oh, this is a better trade because I'm not risking as much, and if it finishes in the center, I have a chance of making twice as much. And that's all well and good if that's all you're looking for. On this side, you're risking $235 to try and make $265. You are getting a little bit more probability here, and the probability is because you're getting a little bit more width. So if this gives me a range of approximately 261 to 265 as the break-evens, the $5 width butterfly is giving me 260.33, which is giving me about another 70 cents, 75 cents or so on each side where you're still within the break-evens. And I'm not saying that either one of these trades is a good trade. There are strategies where people will use these types of butterflies as an income trade, but they will also manage the trade if price starts to go outside that area. And they'll keep the trade in the flat area of the pink line or the current profit and loss. But for the purposes of this course, I'm just looking for you to see that the probability of a basic butterfly when you put them on $3 wide versus $5 wide, the probability by itself of finishing in the profit zone is not very high if you're using an at-the-money butterfly. In the next video, we're going to look at a butterfly that's out of the money, one that maybe you use as a target for where you think price is going. So since the butterfly looks like a net or a butterfly net where you're trying to capture price falling or expiring in this area here, what if we took this net and put it in a place where we think price is going? And if we were to buy options that were out of the money, of course they would be cheaper and our probability would be lower, but our reward could probably be greater. So in the next video, we'll take a look at a couple out of the money butterflies and see what they look like.